Scarlett, to say he has some thoughts is an understatement. We are talking about Tom Barrack, the chairman and chief executive of Colony Capital. Tom joining us from California once again. Tom, it's good to see you. Here's where I'll start. A week ago, our viewers may recall, you warned that the commercial mortgage market was on the brink of crisis, collapse, in fact, and urged banks and government to take immediate action. And since then, we've seen the Fed step in with huge programs and a $2 trillion stimulus bill, the CARES Act, passed. Why isn't that enough?
Eric, good morning. It is enough. I mean, they've been amazing. If you look at what they've done in 18 days, in the last crisis, it took 18 months, right, from the banking crisis of 2007. So the Fed has given Treasury the tools. They've acted across the mortgage-backed security, government-backed, mortgage-backed realm. It's starting to calm. And we'll see in the next few days, as the collateral windows open at the Fed, more support in the investment grade market, which is what it needs, right? I mean, capital markets, difficult for people to understand. We all understand banks. We go to a bank to borrow money. But capital markets, public debt and equity, are 60% of the activity in the economy. So what we have today is a liquidity crisis. It's not a credit crisis. It's not near what 2008 was.
Help people understand why that's happening. Because if they looked, for example, at investment-grade corporate debt, since these programs and the stimulus bill were announced, that snapped back almost unbelievably. But that hasn't happened in the CMBS market, where portfolios are still being, collateral still being seized, packages of loans and bonds are still being liquidated at fire sale prices.
Yes, because there is no market, right? So if you thought of it as a pipeline, that pipeline for liquidity is based on notional marks. It's not a sale of an asset. So if we own an industrial building and you go to sell an industrial building, it takes months to sell. You have a private treaty transaction. You have a real buyer and a real seller. In securities, you have broker dealers, and they're making markets in those securities daily. When they get frightened, when there's a temporary impairment, like now, when there's a fear of payments. Now remember, April 1st, we have 80 billion of rents coming up and about 90 billion of interest payments across consumer debt and ABS. The market's anticipating many of those people are not going to make those payments. Not that ultimate value is gone. So there is no market. There's sometimes asks and there's no bids.
So are the broker dealers, which for the most part are banks in this story, the villains? Because they're the ones who are cutting prices, raising haircuts, and liquidating collateral.
Yeah, they're not villains. They're doing the right thing. Look, since 2008, Dodd-Frank, the banking industry has been cleansed, and they have unbelievable regulatory requirements. 9 or 10 agencies, all great agencies, that are making sure that there's no inconsistencies in the system. But they have a regulatory requirement that says, when X happens, this is what you need to do. What we've been asking the system to do, which is what's happening. The Fed, the Treasury, the regulators are all saying, look, lighten up on the ultimate individual American who owes rent, who owes interest, who has a mortgage on their house, who has a mortgage on their cafe, who has a mortgage on their restaurant. But the regulatory environment on top of it takes time. It's difficult. So what we've been asking everybody to do is a timeout. In Monopoly, we don't want to get out of jail card for the individual restaurant owner, cafe owner who can't make the payment. We want to pass go card. Just let them get 90 days, tack it on to the end of their mortgage. We lend to those people in some of our entities, all of us do. And everybody's asking for forbearance. All of us want to give a forbearance, but we need those forbearances from the banks. The regulators just need to provide that those forbearances are in line with their own capital commitments, which are quite complicated. But they'll get there. Everybody's rushing there. It's just going to be a panic between April 1st and 10th when those payments are made. You're going to have a liquidity flush.
So effectively, if I'm not mistaken, Tom, what you're arguing for is that regulators need to tell banks, don't worry about the losses or the exposure that you see piling up on your own balance sheet. The banks are acting in self-defense. I think that's the point that you were just making. And then what you're calling for, that they, a suspension, if you will, a temporary suspension of margin calls and mark-to-market accounting for portfolios is not, I mean, clearly banks aren't willing to do it on their own. If they were willing to do it on their own, they'd already have done it.
They can't do it on their own because of the capital requirements. And there's no losses. It's a notional illusion. This fair value accounting, mark to market, is an appraisal process that takes place in an illusion, right? There is no market. And there's no market because the government has imposed a cessation of business. This is not a credit problem. The little restaurant, the little cafe, the car wash isn't having a value problem. It has a credit problem because the business said, the government said, you have to shut down your business.
And they're going to miss whatever, rent payments or mortgage payments for 3, 4, 6 months maybe.
Exactly, and tack them onto the back of the loan. Nobody's going to lose money here. It's a time.
Pardon me for interrupting. I was just going to take another side of the argument, if only for argument's sake. And so hear me out for just a second. What you're asking for, at least in the eyes of some other people, Tom, is targeted relief for a market that is populated, for the most part, by so-called big boys. All the participants understood the risks of leveraged positions, of short-term repo financing, of sudden dislocations in price. They just never expected that any of that was going to happen. And all of a sudden it happened. Is that accurate?
Look, it's a valid point that arises from the vagaries of 2008, right? This crony capitalism issue, that the only beneficiaries in the aftermath were the big investment banks and insurance companies. Now, my personal view is that wasn't true. It's certainly not true now. So who are we talking about? We're talking about owners of these buildings, owners of houses, owners of multifamily apartment buildings, little individual owners, not the big ones. The big ones are on the private side. So insurance companies, pension funds, they can afford the equity and the debt side on their own. The other side of it is the beneficial owners of these bonds. Those are 401k plans, they're ETFs, they're individual owners who are trying to do something better than Treasury. This isn't the big guys that own this stuff. The non-bank banks are an intermediary to the banks, just giving them more equity. The people on both sides who suffer here are the little people. It's not the big people.
That's a persuasive argument. So why is it that regulators haven't listened yet? The liquidations continue. I mean, some collateral is being marked at 50 cents on the dollar.
Well, less than 50 cents is enough because there's no market. So here's the problem.
Well, and it was par or close to par less than 4 weeks ago.
Exactly, 2 weeks ago. So at the Fed window now, you have haircuts for different kinds of collateral, which supports that system. So the problem is you have a well-meaning person sitting in Delaware who's in charge of the mark-to-market desk on a certain security. They just have a protocol and a rule book. So they're following that rule book, even though on top of it, everybody's telling them, Fannie, Freddie, the Fed, the Treasury is saying, lighten up. Give everybody a forbearance, but they don't have a manual, right? CARES was brilliant. It was War and Peace written in Russian by intellects that had 180 IQ.
Tom, who needs to step in? Is it the SEC that needs to step in? Is it the OCC that needs to step in? Is it the Fed that needs to step in? Congress? And if one of those bodies, whichever one it needs to be, doesn't step in, what happens? Who wins, who loses?
So you need it from the top. Who loses is the little guy. That's who's going to. They need a timeout right now. April 1st, they need a timeout. They're not going to lose their buildings. They're not going to lose their houses. And you have all of the A team, Steve Mnuchin at Treasury, Jay Clayton at SEC. You have at the Fed, you have Randy Quarles and Jerome Powell. They need to make a statement saying it is our intent to work the regulatory framework to give the individual borrower a break. 90 days, we're going to tack on those interest payments to the end of their mortgages. Nobody's going to lose money, but we're going to have a timeout. And if that doesn't happen, my prediction is by April 20th, you're going to have a intolerable and what was an avoidable clog in the system that will be so far reaching through derivatives, through insurance companies, through all of that 66% of the capital markets that will be global. And it's unnecessary.